Good morning and welcome to the Daily Energy Markets podcast. It is 10:30 a.m. in the UAE, but it is 9:30 a.m. here in Bahrain, where I am at the MPGC. So I'm feeling a little bit of Dr. Carol's pain of waking up earlier than usual, but nonetheless not quite as early as she does, and we're very grateful. MPGC, the 32nd edition, of course, been around a while now in the hands of S&P Global Commodity Insights Platts. So it's a pleasure to be here. The session has just kicked off inside the conference room. And inevitably, all the usual topics at the sort of forefront of their discussions, as they will be with us this morning. And I kick off with Dr. Carol Knackley, CEO of Crystal Energy, with the question that was just put forward actually in the session, and that is there anything that can knock Brent crude oil off this $65 kind of handle where it seems to be stuck? There's certainly no shortage of headlines, Carol, but nothing seems to be moving. After the $10 drop from early April, we seem to be really locked in on this number, nothing much moving it. Your thoughts on anything out there ahead of us that could shift the market?
Good morning, Sean. It's great to see you again, to be here on the show again. Look, anything can knock the balance that we are seeing with Brent for a while, this stubborn kind of range where seems to be stuck. But at the same time, this makes me think that maybe this is the level that is keeping everyone happy. The Americans, maybe President Trump is happy with that level. For OPEC, it seems to be acceptable given other circumstances. But what we are seeing today in the market is that several forces are moving, some in opposite direction, that could justify this balance that we are seeing in oil prices. So I don't like to talk about balance because usually oil prices are quite volatile because they move. But let me just highlight a couple of those forces that I'm mentioning, what is changing and in opposite direction and how they are counterbalancing each other. So first of all, if you think about OPEC plus move, and that is a big a determined factor in today's oil market, people have said that OPEC is doing that. They are accelerating the release of previously withheld voluntary barrels to punish the cheaters. There may be an element of truth in that, but given the history of OPEC and OPEC Plus, I wonder if this is the main reason why they are doing it so gently. Why not giving a big punch and then cause so much pain to ensure discipline? So there must be other forces, and this is where other motives, and this is where I'm thinking about perhaps expectation of some forthcoming gaps in the market. Look at the war in Ukraine and the negotiations with Russia. We're seeing that President Trump is already running out of patience when it comes to dealing with Russia and Putin. And he already threatened earlier this year when he came to the White House, he did threaten with more sanctions, more severe sanctions on Russia if Russia does not sign a peace deal. Iran, maximum pressure at the same time. You do have, like we are heading also to the driving season in the US, and that puts upward pressure on prices. And we do have a slowed down, gradual, very slow, very gentle in US oil production. So when you put all these together, you can see that even if OPEC Plus releases more barrels, it kind of compensates for potential deceleration in the supply elsewhere. And that could justify the prices that we are seeing today.
Daniel Richards, welcome, MENA economist with Emirates MBD. Whatever the multiple reasons, Daniel, that OPEC Plus have gone on this accelerated supply increase, they are due to meet again on June 1st, which is next Sunday. Whether they will continue with this strategy is, in some ways, the question to you, Daniel, is how long can they sustain at $65 on Brent? The result, I mean, it's 65, one for many reasons, but one being this policy of increasing supply at an accelerated level. Do the Gulf states, particularly Saudi Arabia, Daniel, have the capacity to sustain the fiscal hit of this price point? Your outlook for this policy decision?
Yeah, I mean, we expect them to carry on bringing barrels back, and we do expect a weaker oil price through the second half of the year. I think Carol just summed it up very succinctly just then. The pressures are kind of even-sided a bit at the minute, but the kind of upside we think is more limited, especially in terms of how long they can sustain it. I think they've made fairly clear. Obviously, the longer this goes on for, the lower price, the harder it gets. But the way they came out of the traps very aggressively in January, just as they did in January last year, they continue to spend, to launch new projects. There has been headlines about recalibration and a change of scope or resizing some of the projects, but they're still committed to massive spending. And we think a lot of the spending is kind of ring fence. They need to build new houses. They are committed to these major international events. So in terms of budget deficit, we see pretty wide at around 6% of GDP this year. They are borrowing heavily to finance this.
That's 6% in Saudi Arabia?
Yeah, 6% in Saudi Arabia. For UAE, we still see a budget surplus this year. So it's a very different dynamic for UAE. Saudi Arabia is clearly the more exposed, if you like, presently. But at the same time, like I say, we still expect from, if anything, this lower oil price environment, this bigger budget deficit, it makes it even more incumbent on the Saudi government to press ahead with diversification plans, much of which will require funding, will require borrowing in this environment. Debt levels are still fairly low, around 30% of GDP. They still have other avenues they can monetize. We haven't really seen any indication. A lot of headlines several months ago about the recalibration talk, but I think that's more a case of perhaps not going so aggressively for the more fanciful projects like the line and such like. But in terms of the spending on the basics, on the power supply, on the water infrastructure, on housing, on these international events, we do expect that to continue. And as I say, it's almost even more important in this environment that they manage to build up these non-oil industries.
And just for clarity on that again, Daniel, the fiscal stress, you're saying Saudi can handle that. That's even at 6%. I mean, most countries at 6% budget deficit, even the United States, the bond markets are starting to scream a little bit, but Saudi, you're saying not an issue.
Yeah, certainly for the next year or two. Like if this is a 10-year environment, then certainly things will start to look quite different. But I think a lot of this is front loading, a lot of this spending, it's essential spending if they want to diversify. They need to do this. As I say, it's not just those big projects of the line or the headline grabbing things. A lot of this is about providing housing to an economy whose population is growing very rapidly and where housing inflation is at around 7-8%. It's providing the basics for bread and butter infrastructure projects that are needed to power this diversification for decades to come. So for the next couple of years, at least, we think they will continue on this path and that they are in a position to weather this storm. But like I say, a 10-year environment of 6% deficit is a very different story. But in the near term, we do think that they are able to handle this.
Let's go to Venezuela, Jose Bacchus, of course, a very different story there. Jose now currently policy and energy analyst at Jose Pereiro and Associates. Jose, where is one of the ideas that might shift the market here is whether Venezuela and Iran can get more oil onto the global markets and counter the sanctions that they both face. What is the current dynamic now in Venezuela since Donald Trump closed down the Chevron opportunity there? What's the outlook for Venezuela to get barrels, sustained barrels onto the international markets?
Thank you, Sean. Great to see you again. Well, speaking of Iran, we're receiving a new ambassador, by the way, from Iran here this week, after like 4 months without an Iranian ambassador. So that's another part of the story of the relationship between Iran and Venezuela. Yeah, well, definitely. Well, today, the 27th, it's the date of expiration of all the licenses to Chevron and the different U.S. oil services companies that have been operating here in Venezuela for decades. So we'll see if that happens at the end of the day, because that is part of the story of the confrontation between Marco Rubio and friends and partners in Washington and the oil lobbies and, part of the oil businesses in Houston, and so that's another part of the story. If that ever comes into fruition at the end of this day, Tuesday 27th, so definitely that's interesting to see. And also, it's important to say that different Chinese small companies have been interested in investing in Venezuela. We've seen how Venezuelan different authorities have been traveling to China in recent months before yesterday's elections, legislative and regional elections, where we saw how the government got a landslide victory. as everyone expected it. So it all depends also on the capacity by these Chinese small companies and Russian oil companies as well, to see how they could possibly fill the void that Chevron might leave of these 200,000 barrels per day that has been producing in the two Chevron joint ventures with PDVSA. But definitely, I think that by the end of the day, something could come up in terms of these Chevron whole drama,
Certainly,
something
you would think
unexpected.
the Chevron seem to be sort of battling hard in the corridors of power in Washington, and it would imagine that, given the support that the Trump administration got during the election cycle, it hasn't been giving the Houston too many gifts.
Yes, exactly. There has been different negotiations between Washington and Caracas these couple of recent months. Also,
But what does Caracas
mediated
need to
by
do? What does Caracas need to do? What does Washington and Caracas, what do they want the Maduro government to do in order to sustain this oil relationship with Chevron?
Well, you have two delicate issues. One is the illegal immigration of Venezuela as part of this criminal organization, so-called the Aragua, that has been dubbed by the Trump administration as a criminal organization. That's part of the story. There has been different flights of deportations by the Trump administration to Venezuela of illegal migrants of Venezuelans, most of them allegedly accused of being part of this organization by the Trump administration. That's another part of the story. And the other part is how, well, I mean, for U.S. refiners, Venezuelan crude oil has been tremendously important, cheap for their margins, and close to the U.S. Gulf Coast refiners. So I think that this whole story is not going to end today. It's going to continue.
Carol, looking at this discussion with Daniel and obviously your earlier comments, whatever the reasons why OPEC Plus are conducting this strategy and the other factors that are suppressing oil prices, the other countries other than Saudi Arabia who can borrow a lot of money, there's many OPEC Plus countries, particularly in Africa, think of Nigeria and others, who really need an elevated oil price to balance budgets and support various social programs. What kind of duress do you think they're under now, and their ability to influence OPEC Plus to change this strategy?
I'm not sure they'll be able, if you think about the African nations in particular, I don't think they can influence, I mean, they can, of course, they do have a voice, but I don't think they will change the overall strategic direction of the organization, especially if it has been set at the leadership level. And there is also not just, I don't believe it's just based on commercial grounds. There are also strategic, political, geopolitical grounds that should be taken into consideration. And anyway, OPEC Plus and their benefits, the macro perspective of oil markets cannot be held hostage only because of poor management of some countries for their economy or for their squandering the oil revenues. That said, Sean, we have to distinguish between different OPEC Plus members, but let me stick to OPEC countries in particular. Even though there are mostly oil-dependent economies, and oil is the backbone of the economy of all these countries, we can see their exposure to oil prices is very different. And it's not just how much pain they can take from the oil price, it's also how much they have saved on the side for the rainy days. So countries with massive sovereign wealth funds, where they included, I mean, put a big chunk of the revenues there, not just for future generation, but also what we call them the stabilization funds, will suffer less in terms of the impact on the domestic economy from fluctuations in oil prices. So we have to distinguish between those countries, those who have not just the size of the economy, the size of their expenditures, but also the funding on the side in sovereign wealth fund. Countries like Nigeria, I've always argued they have done really a poor job in diversifying their economy and in wisely investing their oil revenues. So instead of going just to OPEC and asking for further cuts or reducing their production to salvage oil prices, I think they should give more attention to their domestic economy and diversify better, and also improve the investment climate for international capital.
Daniel, looking at we obviously look at this policy of lower oil price, or the strategy of OPEC Plus delivering a lower oil price from a supply point of view, from a producer's point of view. If one looks at it from a consumer's point of view, Daniel, at this time, a $65 Brent, an even lower WTI price. What is the economic value? There's some argue and some sort of commentators indicating that this strategy is a gift to the Trump administration while they're conducting this very aggressive tariff war with the rest of the world. Whether that's true or not, it is delivering a lower price point at a critical time. What is the economic benefit of that? And does it even have economic benefit for the Gulf countries?
Well, for the Gulf countries, I guess it's a more of a moot point. Certainly for US, everyone knows the role that played, that oil prices played, especially prices at the pump, played in the US election, or seemingly played in the last US election. But clearly, the price you pay at a pump is a very tangible aspect of inflation. Everyone goes and buys one product at the same time, maybe every week, maybe every 2 weeks, and you notice when prices are up or down. It's a very tangible product of inflation. So if that is lower, then I think clearly it's beneficial to the US economy.
I was in New York myself last week and observed the price at the pump as I passed a gas station. It was only $3.22, and when I was a university student there many decades ago, it was also about $3. So it's amazing that not much changes over the decades on the nominal price of oil or gasoline at the petrol station.
Yeah, I mean, that is incredible. But yeah, it's just in terms of, we've all seen the surveys about inflation expectations, right? They've shot up to multi-decade highs in recent weeks, and that kind of weaker soft data hasn't yet been followed by the hard data from US. Hard data has held up pretty well so far, but consumer confidence indices have been lower, and inflation expectations have been higher. If the lower oil price helps to offset some of those expectations and bring them back down and stop them running away from themselves so high, then it might stop actual inflation becoming entrenched as well. And clearly that will make the Fed's job much easier. They will be able to continue with that cutting cycle, this progressing somewhat more slowly than perhaps had been anticipated. So, yeah.
What is Emirates NBD's call at the moment for the second half of the year for the Fed?
So we've still got 3 cuts. We've pushed back from, yeah. And obviously it's something we're looking at. And I think the risks of that are clearly that there's going to be fewer than more. But certainly that's certainly our published forecast still. We had June. Now we have, July, September, and then Q4. But, as your wow implies, the likelihood, if anything, of any changes to that forecast would be fewer rather than more. We do still think the Fed has some room to cut rates, to move to a less restrictive policy. At present, though, and I think that's been quite clear in terms of the language from Jerome Powell, they are content in a wait-and-see situation. Labor market data, other hard data from the US remains in fairly positive shape. The Q1 growth figures are a bit thrown out by the imports, so they're a bit clearer in the coming months what we had there. And inflation hasn't been running away either yet. The risk is, as I say, those inflation expectations actually started to materialize in prices. So in that environment, clearly a lower oil price, a lower price at pump would be helpful to the US consumer.
Jose, speaking of obviously Venezuela, but what about the rest of the Latin producers? We saw last year, of course, a lot of net oil increase from a particular, the US, but that's so, other Guyana, Brazil. What's the outlook and the impact of this $65 Brent on the producing nations in Latin America, other than Venezuela?
Yeah, it's pretty much grim, the landscape for the different oil companies in South America currently and right now. Colombia is one that has been suffering recently. First of all, because of the restrictive policies that the President Gustavo Petro has been having ever since he arrived in the presidency in Colombia against the hydrocarbon sector. And this is why Ecopetrol, the state-owned company from Colombia, has been turning right now to natural gas production intensively. Also because of the oil production in the country has been dropping importantly. Also, Ecuador is another country that has been suffering a lot. First of all, because of the drop in the oil prices, and also because of the drop in its oil production and the recent recurrent accidents in its oil pipelines, and the instability that has been reigning in the country. Brazil, even though that has been experiencing an important recovery of its oil sector, its oil production has been, expanding, but recently has been reporting a deficit in its external accounts. Okay, that's another part of the story. Also, you have Guyana. Guyana is the bright side of this whole story in South America. It continues to be so. You have Suriname, the neighbor of Guyana, the other kind of important part of this story in South America. But because of these whole madness coming from the Trump administration and the tariffs, against the whole region of 15% against the different countries, for example, the most important blocks in the region, like Mercosur, comprising the most important economically speaking countries in South America. Now you are seeing a rerouting and redirectioning of the exports of the raw materials from Brazil, from Paraguay, from Chile, and its heavy mining industry to Asian markets, for example, or reinforcing its relationship with the European Union. But in general, I'm seeing a very difficult landscape for the whole South American oil and gas landscape.
Let's go to the survey question, which tackles some of the topics that we've been dealing with here this morning. What is most likely to shift Brent crude oil definitively off the $65 rock that it is sitting on? Is it the OPEC Plus policy? We've got a meeting on Sunday. Are they going to change tack, or are they going to keep accelerating? And is that already priced in the market? Most indicators of our research is that the market's already priced in the accelerated strategy continuing. Is it geopolitics likely to shift this price? We're seeing, it seems, a breakdown in the Trump-Putin bromance and escalation in Russia's strategy in Ukraine. Is it the trade war, Europe, US finding China, US, this tariff war ongoing, or none of the above, that all of these are already priced in the market? What is your view on that? Carol, getting your thoughts on where that looks like from the point of view of priced in, but particularly on the tariff side. We have the EU this week very much on the front lines of the Trump trade war. A few weeks ago was all about China. Now it seems the EU's turn to be on the sort of front page of the strategy out of Washington. Your outlook for that, its implications for markets in general?
Couple of things, Sean, before I address that.
Please.
First of all, why not all of the above? Because you put none of the above, I would want to click on all of them.
Most likely to, I suppose, is choosing one. But yes, all of the above is always an option, but not today.
Okay, so just to go back to one of the things that Jose was referring, because he mentioned Brazil, Guyana, and the first thing that comes to my mind, we're talking about offshore. And actually, we always think about OPEC Plus versus shale. But when you look at the non-OPEC Plus supply growth, you can see that offshore, particularly in Latin America, is playing an important role in supporting supply growth outside OPEC Plus. And offshore is likely to continue to play a very important role. It is more immune to changes in short-term oil prices and shale. So it is here to stay, especially that companies investing in offshore. For them, the big investment happen is sunk cost, so they are less exposed, but also they are focusing a lot on extending the life cycle of existing assets rather than exploration. So I would like to bring in, perhaps to future discussion, the offshore picture to the discussion on supply, OPEC Plus and shale, because it's going to play a very important role for years to come. With respect to the tariffs, what we are seeing today is a truce, but not peace. And that keeps this kind of level of uncertainty on the global economic outlook. So if you look at economic forecast, look at the last month's from the IMF compared to the previous one from end of last year, you see most of the countries, if not all of them, were in the red because their growth forecast has been revised downward. And this situation is going to continue with us as long as we don't have a firm outlook on tariffs. And yes, energy so far has been shielded from direct tariffs, but is indirectly exposed to those tariff policies because of the impact on economic growth. So far, I don't think anything has drastically materialized because we remain into this gray zone. We don't know what's going to happen yet, but the sheer level of uncertainty that the tariff war has created is already filtering through the lower economic growth. And if they materialize, and we don't know whether there will be some deals with the US at some point, like the UK signed a deal with the Americans, then that might change the equation. But at the moment, I see a lot of uncertainty negatively impacting economic outlook.
Daniel, just picking up on that and our earlier comments together, the outcome or impact of the lower oil price on the fiscal largesse of a country like Saudi Arabia, the UAE, who not only obviously have to support their own economies, but play a role in the region, particularly with countries like Egypt, also an energy producer, to support the fiscal health of other countries. As we go through this sort of more stressful lower price era, how is that likely to be impacted? The other Middle Eastern countries, big ones like Egypt, that are at the end of the sort of string of this energy income. Daniel? I think he's on mute. Is he on mute?
Yeah, I was on mute, sorry. Yeah, so clearly they haven't got as much largesse or access to as much largesse as perhaps they might have done in the past. And I think what we're seeing in terms of a relationship between the larger GCC economies, or all the GCC economies really, and the rest of the region in terms of support, is that it seems to be now a much more transactional relationship than perhaps it was in the past, where in the past it might have just been, donations, for want of a better word, or grants. Now it is looking for partnerships, investments, and real estate. And of course, we had the Ras Al Hikma agreement agreed, February last year, between the UAE and Egypt, taking that large swathe of land that they've now developed, and then other investments by ADQ into businesses that will generate a return over years to come. And similarly, in terms of what we've seen from the Qatar investment announcement recently in Saudi Arabia last year, it's no longer we are going to deposit this massive $5 billion or whatever it might be at the central bank, or this is a donation, this is support. This is an investment. We are partnering together, and often being run by the sovereign wealth funds or the GREs, which will expect a return over time. So it's not to say it is purely a business relationship. Clearly, there's always some level of support, whether that's due to political security reasons or what you will, but it is more of a transactional nature, I think, than perhaps it might have been going back when oil prices were higher.
Jose, last word with you, just picking up on the earlier comments. How can Venezuela, if we assume, and you indicated that there could be a last-minute reprieve for Chevron to stay engaged in Venezuela, but failing that, can Venezuela still sort of get around the sanctions with getting oil to market, with the Chinese, with the Iranians? You mentioned the return of the Iranian ambassador to Caracas. Will they be able to do what they had sort of done before, where they were up, producing and getting a lot more barrels to the international markets?
Well, it's a total different story today than what the government in Venezuela faced during the previous Trump administration under sanctions. If Venezuela and the government of Maduro was able to, undergo the sanctions, it was only because, it was able to trade and sell its oil, but at heavily discounted prices. But, the industry was very much different than what it is today, but it was not able to recover production. Let's see if it's able today to recover production, if it's able to, alongside with these Chinese and Iranian companies, to pick up on what Chevron will potentially leave, because nobody knows exactly what will happen if Chevron at the end of the day leaves or not. But
and today is
I
the day
think
it has to leave, right? I mean, today you'll know by 6 p.m. this evening or whatever it will be.
yeah, but I mean, it's a total different story. PDVSA has learned, a little bit on how to cope with all this situation. But you need investments without any type of doubt. You need a lot of investments to kind of recover production, even though that we're still facing enormous problems.
Well, we'll have to wrap it up there. It is 11 o'clock in Dubai, and we have the results of the survey indicating trade war is still the most likely to shift the Brent crude oil price off the $65 handle. And that is an ongoing, we're kind of literally in 2 months now, or close to 2 months into this 90-day suspension of the reciprocal tariffs that were announced in early April, and still a lot of drama to play out. And I suppose as we get deeper into the end of those 90 days, those drum beats could get louder, and with it, the impact on the markets. Thank you so much to our guest this morning, Dr. Carol Nachwe, of course, sitting in Germany today, Jose Chaloub in Caracas, and Daniel Richards in Dubai. What I love about this podcast is the ability to go all around the world in 30 minutes every morning. It's a great pleasure to have your insights with Brent crude oil stuck at $65 a barrel, give or take a few pennies. Is there anything out there could move it? A surprise by OPEC Plus next Sunday, maybe, as they have known to do in recent years, go against the expected trend. I wouldn't rule that out. All the best, everyone. Catch up with you all soon again. Regards from MPG.